We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Wojcicki. Joining me today is Michael Pento from Pento Portfolio Strategies. How are you today, Michael? Thanks for joining me.
Doing fine, Tom, and a pleasure to be with you.
It's always a pleasure to speak with you. You know, you're one of our most requested guests all the time. And, you know, you and I were just talking a little bit before we hit record here this morning about this seemingly, not very volatile summer that we've seen that was preceded by a couple bank failures and a lot of actually drama this entire, year before we're speaking here. Cracks in the system, if you will. But I'd like to start talking about part of your book that you wrote about the coming bond market collapse. You presented the idea that the faith in sovereign credit and money supply is being destroyed and in turn going to create volatility in the bond market by spiking yields across different sectors of the bond markets. And you wrote that book just over 10 years ago, I guess it would be. So laying out how you saw this happening, are we now seeing it develop the way you saw it?
So there's actually two different questions there. So can I handle the first part first?
Absolutely.
What I'd like to do. I think, so coming into 2022, I said the market was going to drop significantly, and that prediction panned out. Now, coming into 23, I thought the recession would officially start sometime in 23. I still believe it could, the first half of an official recession. And by the way, paradigmatically speaking, I think we're already in a recession. It's just not an official recession. I think that an official recession will begin. And why do I say that? Because I'm a perma bear? I don't think so. If you look at tax receipts to the government, they're negative. If you look at earnings, they're negative. If you look at average, the total input of aggregate hours worked into the economy, it's unchanged for all of 2023. If you look at gross domestic income, it's shrinking in Q1. So there are so many other things other than GDP, which is really measuring gross domestic consumption more than gross domestic product, if you ask me. We're already in a recession, but I think we're going to have an official recession. The first half begins by the end of this year. So starting in Q4, going into Q1 of 2024, to the end of Q4 2023, going to Q1 2024. So why haven't we had an official recession yet? Why hasn't the stock market melted down in 2023? Is a great question, which I think that was the first part of your question. See if I can remember the second part, or I'm finished with answering the first part. Well, I think mea culpa here, I underestimated the effect of the bank term funding program launched in March by Jerome Powell. That effectively bailed out the entire banking system. That's what it did. It guaranteed all deposits, and it opened up the discount window to something called, again, the Bank Term Funding Program, which gave people the ability, entities, financial institutions, primary dealers, and others, to give their assets, mortgage-backed securities, corporate bonds, and treasuries to the Federal Reserve at par for a year. Discount window is only 90 days, and there's a haircut there. So it's a really huge program. Well, how big was the program, you ask? I'm glad you asked it. So from 1913, the formation of the Federal Reserve, all the way till the end of 2008, the Federal Reserve balance sheet was $800 billion. In 2 weeks, it expanded by $400 billion. Just giving the context of how much money was printed and monetized in just 2 weeks in March, okay, when those banks began to fail. So that really, I call it QE light. It wasn't really QE because this is just an open monetization. Let's see what happens in March, Tom, when these loans come due and they have to be sent, the assets go from the Fed back to the primary dealers. And then they owe the Fed interest, right? And they have to take these assets back, which are not at par, given the Fed's interest rates are still going higher. A lot of these assets are treasuries, which are and mortgage-backed securities are way underwater. So let's see what happens. But I think that is why I underestimated, or at least I anticipated, a collapse in 2023. The collapse was beginning to occur and was, submarined or underwritten or supported. You use the adjective. It was precluded by, obviated by the Federal Reserve and that massive bailout of the entire banking system, which was very quiet. It was like a tacit, under the table bailout. You think if the Fed bailed out the entire banking system in the United States, it would make a big deal. It'd be all over the news. But it was kind of like, oh, it's the Bank Term Funding Program. Isn't that wonderful? So that is why we didn't collapse in 2023. And my model, which I created, told me that it was not time to get short the market. So whereas it did warn me that we are heading for a recession, and we're still heading for a recession, it is just still not telling me it's time to take on any direct shorts into the market. So that is the reason why we've been delayed. Now, you asked me about my book about the coming bond market collapse. See, I did remember the second part of it.
Michael, just to follow up on that, maybe before we get to the bond piece, considering that we have this deadline that the Fed might be able to see or should be able to see this year from when the Bank Term Funding Program was implemented, don't you think that the banking system and or the Fed is going to be able to anticipate what the consequences of those loans coming due is going to be?
100% do. I wouldn't be surprised at all if come March 14th or that, in the middle of the Ides of March, the Powell comes out and says, you know what, we're just going to extend the facility. I mean, that wouldn't surprise me at all. I mean, he has to extend the facility. It would shock me if he said you can't roll over those assets back to the Fed. Because if he didn't do that, then you have all these entities around the world. Some of them are huge entities who were going to be stuck with all these assets that are underwater. They're going to go out of business. They're insolvent. The only reason why by March of 24 Powell wouldn't extend the Bank Term Funding Program is that he was slashing rates like a maniac, below the asset, the incomes of these banks, which are their mortgage-backed securities and loans. And if that was the case, if they were slashing interest rates to that degree, it would mean that we were already in a depression or a recession, severe recession. So that doesn't really bode well for the banking system anyway. So I think either way, this program has to be extended and pretended on in March. There's no doubt in my mind about that.
Yeah.
So the obvious follow-up on a question to that would be, well, why would that necessarily engender a bear market then in 24? Because I think just the economy been slowing down so sharply. Remember, when you have a QE program, the Fed buys these assets, monetize them forever. They tell the primary dealers, here I come, I'm going to be buying, 90, whatever, $85 billion a month of your bonds. You're going to get something called Fed credit reserves, which can be used to buy more bonds, make loans. It actually can be converted to cash too, for withdrawals, for deposits. So it's basically high-powered money. I'm not going to ask for that money back. I'm not going to give you your assets back. That's your money. Go and buy more bonds, because the next month I'm going to come by with another $85 billion or whatever the number they come up with. I'm going to buy more bonds. So those bonds are going to be in a big, big bull market, and prices, yields are going to go down. So go out and make loans and gamble like drunken monkeys. So that's QE. Okay, this is not QE. This is a loan with a term and an interest rate attached to it. So it's different. It's not QE. So what am I saying there? I'm saying that the economy is slowly deteriorating. I'm saying that the consumer is in big trouble. Record amount of credit card debt. Student loans have to be repaid. The interest on that debt is skyrocketing. It's just a natural degradation of the business cycle. So I think we're going to be in trouble later on this year and in Q4 of this year and in 2020 and 24.
So getting back to that bond piece, this volatility that we can see coming in the bond markets, let's say, having presented itself in places like, let's say, the UK last year or Japan, having to either choose to save their currency or save their bond market. Are these the symptoms and the start of volatilities within that bond market?
Yeah, and when I wrote the book in 2012, 2013, I wasn't predicting something that was going to happen imminently. I said eventually what's going to happen is that the Fed, because of its policies of interest rate repression, would eventually get inflation to become, have traction. And inflation would eventually eclipse their 2% asinine target and then just run amok. So inflation went to 9% officially, and unofficially, in reality, it was closer to 20%. So now the Fed has broken that logjam of inflation that lasted for many, many, many years. Remember, for years, they couldn't get to 2% inflation. They were constantly undershooting it. Then they figured out, which I knew all along, they should have called me and asked me, how do you get inflation going? Well, you tell people to stay home and not produce anything, and then hand them checks. It's called helicopter money. So they directly monetize debt, and they circumvented the banking system. They just handed people checks. Treasury handed people checks. The Fed monetizes that debt directly. So that's what happened, and that's what we got. We got runaway inflation. So if they tried it again, so inflation was sending bond yields higher, okay? That caused the Fed to raise the Fed funds rate from 0 to 5.25% to 5.5%, probably 5.5% to 5.75% by the time they're all finished, said and done with their monetary tightening. So that is the fastest rate of change in rate hikes in the history of the United States. It's never before, in 18 months, gone up 550 basis points. And especially when you think about it in those terms, where coming from 0, that's a big, big change in borrowing costs. So now so what's going to happen next is we're going to have a recession. And the recession is when, what happens when a recession, of course, is when, the revenue to the Treasury dries up because the automatic stabilizers kick in. So you have this massive increase in debt and deficits from an already crazy, $1.5, $2 trillion level. This is a wartime deficit in peacetime. You have a massive supply of Treasury issuance. So what's the Fed going to do? They're going to have to come in and monetize all that debt. And that means the way I think about it is that you already broke the mindset. And so you've inculcated to the market that you can never raise interest rates to a real level, higher than inflation, or their R star. They call it, it's ironic, they call it their R star, which is the neutral level of a Fed funds rate that's neither stimulative to the economy or depressing the economy. But they can't see R star because it's obscured by clouds. So I think that's hysterical. I think it actually was refreshing from Jerome Powell to admit that he has absolutely no idea what he's doing. I mean, I knew it all the time, and I've been telling people that these people, there's no omniscience at the Federal Reserve. So, and I'm not blaming them, I'm not isolating them. You can never take any group of people, 15 people, whatever the number is, a small group of people, and tell them, okay, now divine what the exact cost of money should be at all times. It's just something that should never be left to a cabal of people. It's something that should be left to the free market based on the supply of savings versus the demand for money. That's the way the free market would regulate it. And by the way, the supply of money should be determined by gold, or something that doesn't increase by 40% a year, the way M2 was surging. So the supply of gold increases by about 1 to 2% a year, which is practically commensurate with population growth plus productivity growth, which means that the money supply is always static or stable with the economic growth. That's how you get stable money and stable prices and stable interest rates and stable inflation. I don't know why they don't understand that. Well, I guess they do. Because the Federal Reserve was put in place to what, Tom? Bail out banks when they get in trouble. And guess what? Guess what they did in March of this year. Not last year, this year. And they did it in a heartbeat, with alacrity, in a nanosecond, and they bailed out the entire financial system. So anyway, to finish my thought, sorry for rambling, but the rate of inflation is going to skyrocket past where it was officially 9% the next time. If they were to go back into the ZIRP and QE regime, again, knowing what after inculcating to investors exactly what they're doing and where inflation went last time, it'll break much higher than it was before. Because why? Again, because investors will become completely aware that the Federal Reserve is incapable of raising interest rates to a level that is above inflation and keep it there. That's the simple answer.
Yeah. Michael, do you think that they're going to eventually have to raise their inflationary target to, let's say, 3.5% from their 2%?
Yeah, I really get angry. I hear that on CNBC all the time and Bloomberg. Wall Street's begging this. They're begging for this to happen. Oh, please, sound money, sound stable money used to be where your money didn't lose value at all, 0% inflation. That was their stated goal given by Congress in 1913. So stable prices. Now, stable prices is I guess, a very subjective definition. It's not objective. It's a very subjective definition where you could say, well, stable prices mean 2% inflation. And then 2% inflation target means inflation goes to 20 and home prices go up 43% in 2 years. So now, since they can't get to 2%, we're going to say, let's just go to 3. I mean, this is what gets me so angry, because if you raise the target from 2 to 3, which is a 50% increase, and you can't get that, because once you do that, what is Wall Street going to say? Oh, well, if they can't hit 3, right? Well, why not 4? Why not 5? And that means in reality, inflation is going to be double digits and going higher. So the Fed is an odious organization by design. And I think if they did something like that, imagine how much, well, first of all, they'd lose all credibility. They've already lost it with me. But I think they lose all credibility with the public. And I think it would be very dangerous for the middle class of this country. In fact, I know it would be.
Yeah. Michael, is it just trying to think through, let's say, the order of operations here, and when we get into an official recession, you were talking about having an equity market meltdown. Does that start to happen? The equity markets start to melt down, and then the Fed pivots or comes in with more QE. Does that in turn create a melt back up in stock prices? Or, can we be in an environment where we just have the stock market crash and that scares investors out of the markets?
No, I look at history here, and I think you have a crash of the U.S. currency when the Fed finally relents, and I think they'll do so with reticence and reluctance. Then when they go back to QE and ZIRP, I think it'll destroy the dollar. Mm-hmm. And I always look at what the markets did in hyperinflationary times. They all went up in nominal terms. In real terms, they got devastated, but in nominal terms, they did fantastic. Mm-hmm. So if you're just worried about a nominal return, I wouldn't short the market. I would never short a market that was being subject to massive QE and helicopter money and zero interest rate policies. I just wouldn't do it. It wouldn't make any sense to me. I would just buy a bunch of gold and energy base metals. I want to make one more point though, too, about the rate of inflation. The rate of inflation, let's just say if it went to 9%, like it did last time, let's say it goes back to 9%. Basically, the Fed is saying that that means that the value of the dollar is going to lose half of its purchasing power in 8 years. That's the way the math works on that front. How could that possibly be the philosophy or the stated goal or purpose of the leader who's in charge of the world's reserve currency? Mm-hmm. That currency would lose its value in half of its value in 8 years. It just can't happen. You have to return to, if you're going to have the world's reserve currency. And by the way, we're losing that status gradually, and that gradualness is becoming expedited. I think it would totally destroy the U.S. dollar as a world's reserve currency if they ever left that 2% target, raise it to 3%. And I think it's going to happen anyway, because in the next recession, you're going to have deficits that are going to be 30, 40% of GDP. Deficits. I didn't say debt, I say deficits. 30, 34% of all income coming in is going to be just, interest on the debt. So you have to get the Fed involved in that. And that becomes a death spiral for the Federal Reserve. Print money, create inflation to keep interest rates low. That's sort of, an antithetical practice. But that's where I think where we're headed. So so you're asking me, would the stock market collapse in nominal terms? I would say probably not, although I wouldn't rule it out. I wouldn't bet against that. I would bet against a market that crashes in real terms, and I would invest according to that dynamic.
Right. When we're talking about the size of the deficits, the size of, let's say, entitlements, if we include the obligations of the U.S. government to its citizens through programs like Medicare and old age entitlements, how much runway does the Congressional Budget Office forecast it has until entitlements alone take up 100% of tax revenue?
I think there was 2040, if I remember correctly. I don't have. Is that the number that 2040? So that doesn't seem like maybe because I'm getting older. I'm 60 years old now. 2040 doesn't seem that far away any longer, right? So we're going to be there before you know it. So 100% of all revenue is going to be entitlements and interest on the debt by 2040. That doesn't leave much room for any. When I say 100% of all revenue, that means the government can't spend money on anything else. Nothing. There's what else can you can't have any federal employees. So you think about an economy that would be absolutely in a free fall if that were the case. And that's the thing that gets me, Tom. I keep hearing, and a lot of people who should know better keep talking about how the government can just run these massive deficits because it's very stimulative to the economy. Really? So you run massive deficits. It might be stimulative in the short term. But massive deficits and economies, deficits pile onto debt, right? So you have a very high debt to GDP ratio. This is what you get. You have high taxes, high interest rates, high inflation, and it is a productivity killer, a private sector productivity killer to have massive deficits. So, when you talk about why did the economy not crash in 2023? It was because we had a very high deficit. Please don't just end the sentence there. Say, and if we continue these deficits, we will destroy American productivity, which has already been decimated. And we're going to just bring about a nation that's mired in stagflation, no growth, and record inflation that's increasing. That's not, I don't care if you have your own currency. You just can't bring about a viable and healthy economy by running massive deficits. That's not the whole story, Tom. You know that.
Yeah. Well, it seems like there's only, let's say, this equation can only resolve itself in three different ways, either by raising taxes dramatically, cutting entitlements, which both of those are very politically,
untenable,
or hyperinflating the currency. So don't you think that this crisis point in the currency that we kind of touched on earlier will happen before we get to that 2040 point?
Yes, I do. There's simple answer to your question. Yeah, Yes, I do.
Yeah,
we're going to get to that crisis point. The market will anticipate what's happening. I think it happens after the next recession. That's what I think. That's when I think it happens. That's when the Fed is going to say, okay, I could either provide real interest rates, have a cathartic depression, wash out all the excesses, allow people to buy a house, first-time home buyers to afford a house, pay a credit card bill, afford a personal loan, pare down, all the debt levels get pared down. So debt gets reset, renegotiated, defaulted on, and then you can have a viable economy on the other end of that. But no one has the heart to tell you the truth. what this economy really needs at this point, given the amount of debt that we have outstanding, and given the level of asset prices, given the stock market's at 165% total market cap to GDP, has no business being anywhere near there in history. History shows it should be closer to 75, 80% of GDP. But it's two times where it should be, historically speaking. You have to have this, I call it a grand reconciliation of asset prices and debt. But if that happens, you talk about a short-term cathartic depression. Who in power will tell you that? Because they can't, because it's all about keeping power. You have to explain it. You have to educate the public, explain to them what they did wrong, what's needed to correct the problem. And then on the other end of that, you'll have a great economy and a great United States of America, the greatest country in the world. So why would you not do that? Mm-hmm. Because you are in there, you're not in there to do the right thing. You're not in government to do the right thing. You're in there to keep power. So how do you keep power? You're going to slash interest rates. You are going to
keep the party going.
Monetize trillions of dollars in debt, which is going to be helicopter money dropped to the population. And that'll destroy the United States dollar. Mm-hmm. Not only against hard assets, but even against other flawed fiat currencies.
Mm-hmm. I was going to say, is that it's basically a global problem at this point. It's not just the US that's in that boat.
Tom, I mean, Japan is worse than the United States. China is a basket case. Europe is horrific. Mm-hmm. So all of your, the largest economies on the planet, which are the United States, the Eurozone, and China, mm-hmm. And then Japan. So you can't get any bigger than those four entities, those four nation states. They're all in the same boat.
Yeah.
That's why I think, the BRICS, you have Brazil, Russia, India, China, South Africa. If they have a currency that is backed by gold, that would supplant to a great degree the world's reserve currency, the US dollar. Mm-hmm. And again, they have the courage to go, they have the courage to launch it and stick by it. If the United States had a currency backed by gold like we did before 1971, we wouldn't have these problems. We would not be able to run huge deficits because we'd run out of gold. If we run out of gold, interest rates would spike and the economy would collapse. And guess what happens? That means savings rates would eventually replenish and we'd get our gold back.
I was going to say,
we live in a fantasy world, a fantasy global economy based on voodoo, pixie dust, confetti, paper money.
I was going to say, it seems like we're still in the first part of that sentence where we have high interest rates, high deficits, but we haven't faced that reckoning yet.
No, we're that's all in the queue.
So, Michael, you have a framework of sectors where different economic indicators have a particular outcome. So do you see, once we see that we're officially in a recession, does that come with deflation? And at what point do your indicators point you towards shorting the market and getting back into gold?
So if you look, I'm not back. I'm not out of gold. I sold my gold mining shares a couple of months ago, I believe, if I remember offhand. It was a while back. I still have about 10% physical gold. Mm-hmm. So that's holding up very well, even though interest rates went, much higher. I think gold senses what is in the queue. They know that Powell's about to blink. Maybe it may be as soon as really like a month or so from now. Mm-hmm. We're entering into September very shortly here. So gold figures this out. I think the most important thing is that you look at so I have 20-point model, as you mentioned. And there's different components to it that update at different durations. So there's daily components, there's weekly components, there's monthly components, and there's quarterly components to it. So if you look at that, the stochastic part of it, the high frequency components, they have kept me from shorting the market. So just so you know, what they are. I look at credit spreads assiduously.
Mm-hmm.
So credit spreads are telling me that there's not a problem right now. The market. So when do I want to short the market, Tom? I want to short the market when the market is getting ready. The stock market is getting ready to collapse. The stock market is not going to get ready to collapse until I see those high yield spreads blow out, until I see financial conditions tighten rather than loosen. Mm-hmm. Right now, is it surprising me? Yes, but I'm not going to sit here and tell you that I'm going to tell the market what to do. I'm long right now. I have a long portfolio. I'm long more of the safer components of the economy. So I'm long utilities. I'm long healthcare. I have a little bit of tech in the portfolio, but I'm massively long short duration U.S. Treasuries too, and I'm getting over 5%, pretty much risk free. So, and I own the 10% of gold too. So we're doing fine. We're doing okay. We're not keeping up with the averages this year. We blew the averages away last year, but this year we're underperforming the averages by a lot. But all in all, we're still, if you aggregate the 2 years so far, we're still ahead. But I will short the market when the market is ready to tank. Mm-hmm. And what will give me those clues will be initial claims spiking, credit spreads blowing out, and financial conditions tightening. Those are the highly stochastic, or those components that update daily, that I will look at daily and weekly. I will look at to let me know when it's time to safely short the market. Don't want to do it beforehand because I don't have what I call a philosophical investing standpoint. I don't just say this should happen. Mm-hmm. I'm right, and I'm going to do it because eventually, my trade's going to work out. That's not the best way to manage money. You want to be a successful money manager. Is you want to do and get ahead of what the market is about to do. And I'll know that because of this arcane predictive, foreboding components of the model, which lets me know when the prices of equities are about to decline, because these components will lead the stock market. Mm-hmm. It doesn't go the other way around.
Yeah, I like the idea of trusting the model and sticking by it, regardless of what you feel is eventually going to happen, right?
Yeah, I mean, if I would have stuck to my guns, I would short the market in a net capacity in 2022. If I would have stuck to that, I would have been maybe out of business. You imagine being massively short NASDAQ right now, like some people have been. So, it's one thing to just sit here and be a philosopher and say, one day gold stocks are going to go to the moon. Well, that person is correct, but I'm just trying to get the timing a little bit better. That's all.
Yeah. Michael, are there any particular, let's say, hard assets or other commodities that are going to be part of, let's say, what we could call a commodity super cycle, or is this going to be more concentrated to gold and safer assets like that?
Well, if you look at the back test on that, you want to own base metals, energy, precious metals, and shorting. What I will do is I will short, and I can do this for IRAs too, because I don't technically short the market. I go long ETFs that appreciate in price when the market goes down.
Right.
So when bond prices crashed, I have an investment that I will use that will go up in price as the bond prices crash. This ETF will go out and buy puts on bonds. So buy futures on bonds. So that's how I anticipate profiting during the next inflationary cycle. But if you want to be specific about duration timing here, what you do not want to do, you want to avoid completely, is being long energy and base metals in a deflationary recession/depression. They get wiped out. Mm-hmm. You want to be out of that complex, and especially out of those equities. So I'm very cautious about being long energy stocks at this time. They'd probably be, in front of the line when the Fed is able to reliquefy the banking system. And I think they will be able to do that. They already have the facility in place. So after the recession, becomes manifest, and after these assets become under duress and the stock market plunges, and then the Fed just says, okay, we have the BTFP, but we're actually going to launch some form of helicopter money along with the Treasury. That's going to happen. That will bail out the banking system and consumers. Take some time. Remember, back in 2008, the Fed went to zero. By the end of 2008, they had 0% interest rates and were doing QE. It wasn't until March of 2009 when the market bottomed. So you got to be, you try to be as careful as possible about timing. But eventually that will reliquify the banking system. And then and consumers and asset prices. And then watch out, because after that happens, Tom, when is the next time any Fed chair will come out and say, we are now going to raise interest rates and we're going to, raise them above the rate of inflation? Who's going to believe them? Mm-hmm. Because we know what happens. We will clearly know what happens. We will be inculcated over, teach through repetition what happens. The economy, the level of debt, which will soar, and the level of asset prices, which will soar after the next recession, will be so great that no one will ever believe that the Fed can restore any kind of honest monetary system for our country.
Mm-hmm. So, is that the point at which people, change their behavior, start buying what they need to as soon as they can, or as soon as they get their hands on money? Does that start that self-reinforcing hyperinflationary cycle?
It very well could. It'd be very sad if that's the case. The United States is resembling more and more like a banana republic as the years go by, not only monetarily but politically too. When you go after and try to arrest former presidents and put them in jail or kill them, that's something that happens in banana republics. It doesn't happen in the United States. So we are unfortunately headed in that direction. And I am not a huge Trumper. So don't mistake me from what I said. I'm a libertarian, and and that means I love freedom. And this is not the way this country is heading. It's not heading towards freedom. It's headed towards banana republic status.
Well, it seems the level of tyranny, the level of censorship, the level of outright control that is, being hinted at, again, kind of going back into fall here, seems to be growing ever more. And it doesn't seem to ever be taking a backtrack. Once freedoms are given, they're never returned, right?
Yeah, this is the entropy of the United States. It's a law of physics. It's happening. Mm-hmm. This opens the door too for all this cryptocurrency BS. So I think that just launches the table for a Fed coin to be enacted. Like, hey, we need to control the money supply. We need to know everything you're doing, and we need to have complete control of interest rates. Mm-hmm. The Federal Reserve then has a Fed coin. That means everybody gets a digital wallet, and the Federal Reserve will give you your money that you need to spend, almost usurping Congress at that point. They have the ability then to usurp Congress, because they're the ones that set, they can put a negative interest rate on your money in the bank. Nothing you can do about it. You can't take the money out of the bank. You could either leave it there or spend it. Talk about your velocity. So this is the way, it's not a good picture that I'm painting, and I don't do it on. I'm not doing this to, I'm not selling a magazine. I don't sell gold. I'm here to make money for my clients and myself. And this is how these are the dangers, the very real dangers that I see out there. Hey, maybe, but I'm not a philosophical investor. What if we have a recession and Jerome Powell and the banks begin to, they send all of their assets to the Federal Reserve, the Fed's balance sheet, skyrockets to the moon. The dollar plunges, chaos is in the streets. It's a very steep recession, morphing towards metastasizing towards a depression. And then what if Powell says, this is what we really need to really restore order? I'm fantasizing, allow me to fantasize. This is what we really need to restore economy back to a free market-based system. So let's let it happen. Well, that would change my investments dramatically. Yeah. I don't think that's what's going to happen. I'm just laying out the history of the Federal Reserve and what's most likely to happen. But I'll invest by what's occurring, not what I think should happen.
It seems like they could float the advantage of having a CBDC by saying this is what we need to get money into people's hands the fastest way possible so that they can get it spent and start re-stimulating the economy as quickly as possible instead of, acknowledging these lagging effects that they know are present.
Much more efficient than mailing checks. That's what I said. I said that the Fed could obviate, circumnavigate Congress and say, this is what we need to do. The Fed and Treasury, without Congress, because they're not the same thing, could say, listen, we know Congress might approve it, but maybe they won't. But who cares? I mean, the Fed has that authority now through their emergency lending. What's that called? Anyway, they have the authority. I don't know. I can't remember the exact statute, but they have the authority, the emergency lending procedure statute. They can go out there and just do anything they want. And remember, before 2007, the Fed was never allowed to buy mortgage-backed securities or corporate debt. Yeah. That was completely anathema. But because we had a crisis, they enacted this emergency, stipulation, and they just did whatever they wanted to do. So, and Congress gave them the approval. But with a CBDC, a Fed coin, central bank digital currency, they can give you money and attach any interest rate they want on that deposit.
To try to stimulate either way that they want, that they think that they can have control on the economy to make it go.
If asset prices are plunging and they need to get the real estate market back to its record home price to income ratio where it stands right now, even dwarfing where we were in the previous high of 2006. How do you do that? Well, you have to do that to save the banks, because the banking system doesn't function when their mortgage-backed securities are underwater. The whole financial system would melt down. So how do you do that? Well, you just tell people you can't take money out of the bank. Here's your deposit. Now go and spend it and start buying some houses. And if you don't do that, we're going to have a negative interest rate of minus 5%. You'll lose it if you don't spend it. What do you think people will do?
Blow up the housing market.
Yep. Exactly.
Michael, we're coming up against time here. I want to thank you for an interesting and wide-ranging conversation here. Is there anything else that's on your mind that you think we should go over before we do?
I think we covered enough for today.
Excellent.
And if you have me back on in the future, I'd be glad to talk about a whole host of issues.
Absolutely. Of course, you do the midweek reality check over at pentoport.com, where it's a midweek kind of review podcast of what you see in the markets, what you see, let's say, around the world. And also on Twitter at Michael Pento, right?
Well, I'm not really active on Twitter. So if you want to email me, it's mpento@pentoport.com. The website is pentoport.com. And the phone number for the office is 732-772-9500. If you have $100,000 to invest, we'll manage the money for you, and you're a U.S. citizen, according to the inflation, deflation, and economic cycle model that I created. If you don't have that, then you could subscribe to the podcast. It's $50 a year. Get really good information and analysis that's, without an agenda. So, I'll tell you the truth wherever the truth leads.
Like you say, looking at reality for what it is and acting accordingly rather than what you want to have happening.
Yeah, because I'm not, the fact that I don't sell anything gives me the freedom just to report on the truth. So if gold is going to be in a bull market and gold miners are going through the roof, then I'll tell you when I think it's time for that to be the case. And, when it's time to short bonds, I'll do that. And when it's time to buy bonds, I'll do that as well.
Excellent. Thanks so much for your time, Michael.
All right. Thank you, Tom. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.